Welcome to today's board meeting. We have two topics on our agenda today. The first is an update from our staff, an opportunity for our board to give feedback on the hedging research project. And the second is for a subset of issues, board decision on whether or not we want to add something to our agenda related to, I'll call it shorter term initiatives related to hedge accounting. But with that, let me turn it over to Aaron and our team, who will tee up a little bit of an update on our hedging research project, and then we'll have an opportunity for the board to offer some comments and observations. So, Aaron, thank you.
Thanks, Rich. Good morning, everyone. Today, we'll discuss feedback received on risk management and hedge accounting in response to last year's agenda consultation invitation to comment, or I'll refer to it as the ITC, as well as feedback received in agenda requests. We'll then recommend a plan for addressing that feedback through a series of potential projects and ask the board for input on that plan. Afterwards, we'll ask the board to decide whether to add a project to its technical agenda to address three narrow hedge accounting issues that could be resolved in the short term. As many of you know, hedge accounting has a long history. I will briefly summarize that history to give context to the feedback received from stakeholders. Hedge accounting was originally introduced by FAS 133 in 1998. The most significant provision of FAS 133 was that it required the recognition of all derivatives on the balance sheet at fair value. Hedge accounting was a follow-on issue that resulted from that decision because the positions entities are hedging with a derivative may not be recognized at fair value or recognized at all, giving rise to asymmetry in accounting. The hedge accounting hedge accounting is an attempt to fix that asymmetry. The hedge accounting model, introduced by FAS 133, was intended to be a stopgap measure, while the board pursued its ultimate objective of having all financial instruments measured at fair value. When FAS 133 was introduced, the board was committed to revisiting certain aspects of the hedging guidance as it made further progress on its broad project on fair valuing all financial instruments. Measuring all financial instruments, both derivative and non-derivative, at fair value would have eliminated the need for hedge accounting for risks inherent in existing financial instruments. Ultimately, the board never finalized a project that would have measured all financial instruments at fair value. But the original hedge accounting model largely remains intact today. Over the past 10 years, the board's objective for hedge accounting has evolved, with its aim now to more closely align financial statements with the underlying economics of risk management activities. Because the objective of hedge accounting has changed, but the core pillars of the model have not, it has become increasingly challenging to modernize the guidance so that it more accurately reflects the economics of risk management activities without compromising those core pillars. Moving into the ITC feedback, 29 ITC respondents provided feedback on risk management and hedge accounting. Most of those stakeholders noted that the area should be a top priority. However, some were neutral on priority, and a few identified the area as a low priority. 2025 ITC respondents explained the provisions in hedge accounting that make it challenging. That feedback is detailed in the board meeting handout, but I'll summarize it and the main themes. Those themes were that hedge accounting is prohibitively complex for many entities to apply, especially for those entities that lack in-house subject matter experts or the capacity to hire external advisors. In addition, entity-wide and net position hedging strategies can't be reflected. The foundation of the hedge accounting model is based on establishing discrete one-to-one relationships whereby a specified derivative is formally designated as mitigating the risk exposure stemming from a specific asset, liability, or transaction. Stakeholders noted that for entities in industries like banking and insurance, risk management activities are based on total entity-wide exposures rather than individual items, and therefore common economic strategies employed by those entities do not fit neatly into the hedge accounting model. Also, multinational entities that often seek to economically hedge net FX exposures stemming from a particular jurisdiction can't apply the hedge accounting model to that net position. Also, eligible hedged risks, hedge items, and hedging instruments are limited, and the effectiveness threshold and assessment inputs do not align with management objectives because they include factors that management may not consider when determining the relative success of a strategy. This is particularly relevant to entities that buy and sell commodities. And finally, disclosures are voluminous, but oftentimes lack decision-useful information. Investors indicated that they primarily use information provided on risk management and hedging activities in earnings presentations or non-GAAP metrics rather than financial statement footnotes because the information provided in hedge accounting disclosures is of limited utility. And that's especially true for those entities that centrally manage entity-wide risk. Investors stated that the disclosures should be enhanced to better convey the economic substance and strategic purpose behind an entity's risk management activities and should include an entity's risk exposures, strategic rationale for hedging, and the cumulative effect of an entity's risk management activities. Respondents provided numerous recommendations to address these challenges. Some recommended a holistic reconsideration of the hedge accounting model. Others suggested retaining the model, but making the core components of that model more flexible such that common risk management strategies would qualify for hedge accounting. In addition to recommending either of those approaches, many stakeholders encouraged the board to make targeted improvements in the near term while a broader project is pursued. A few stakeholders just favored that narrow, limited scope project. Based on that feedback, the staff has developed a plan for grouping and addressing issues in stages. The staff recommends that the board address the issues in 3 stages: short-term, medium-term, and long-term. Each stage would be its own project. The staff believes that 3 separate project teams could work concurrently on the projects so that the issues that could be resolved in the short and medium term would not be delayed while the board makes progress on a long-term project that would more fundamentally change hedge accounting. The staff appreciates that this recommended approach would result in 3 implementation efforts for the entities that would be affected by all 3 projects. However, each project would incrementally allow more economic hedges to qualify for hedge accounting, and because of that, the amendments in the projects would be directionally consistent. Also, based on feedback that we've received at meetings in the 4th quarter of 2025 held with preparers, they indicated that they preferred an incremental approach with multiple implementation efforts over waiting for the completion of a long-term project with a single implementation. In the short term, the staff recommends that the board address 3 issues. The issues in this group could be addressed with minimal amendments to the codification, but the staff believes that the changes would meaningfully improve GAAP. Michael will explain those issues in more depth in the next portion of this meeting. In the medium term, the staff recommends that the board address 1 issue, and that is expanding the portfolio layer method, or PLM, to liabilities. In addition to the 2025 ITC feedback that we've received on this issue, the board has received agenda requests from the American Council of Life Insurers and the American Academy of Actuaries recommending that the board add a project to its technical agenda on this topic. Based on outreach already performed, the staff thinks that amendments to extend PLM to liabilities could be made without compromising the core pillars of hedge accounting, which is the staff's rationale for separating that issue from those that would be addressed in the long-term project. The staff plans to ask the board whether it wants to add a project to its technical agenda to extend PLM to liabilities later this year. And with respect to the long-term project, the board has been consistently amending the hedge accounting guidance in narrow projects since it was introduced in 1998. Because of that, most of the issues remaining to be resolved can't be addressed in narrow projects. The staff believes that a project that is broad in scope is needed to address the majority of the issues identified in the 2025 ITC. The extensive nature of that potential project would inherently result in a longer period for completion. Issues that could be resolved in a long-term project would require significant amendments that could change or eliminate 1 or more of the core pillars of hedge accounting. Based on feedback received, the staff has identified 2 paths for a potential long-term project. Path 1 would retain much of the mechanics of the current model, but would allow broader application by relaxing the requirements to qualify for hedge accounting. In contrast, Path 2 would not retain the mechanics of the current model. Instead, Path 2 would refine the objective of hedge accounting to reflect the economics of risk management activities while streamlining the complex mechanics that exist under current GAAP. Path 2 represents a more comprehensive change than Path 1, but would still primarily focus on the accounting for derivatives from a scope perspective. Under Path 1, documentation and testing requirements could be relaxed and more transactions could be made eligible for hedge accounting. But it would retain the elements of today's model that prohibit net position hedging. Nonetheless, the staff believes that expanding eligible hedged items could significantly increase the applicability of the model under Path 1. Moving to Path 2, the staff believes that it would be scalable so that it would be able to equally reflect the economics of basic strategies. So, for example, a corporate entity that is economically transforming one piece of variable rate debt to fixed rate debt, and to complex strategies. For example, banks and insurance companies that centrally manage interest rate risk stemming from both sides of their balance sheet on a net basis. Because of that, under Path 2, the staff thinks that it is best to develop one model that is sufficiently flexible to capture a wide range of risk management strategies rather than separate models for entities that manage net positions versus those that don't. The staff also thinks that a single model would be easier for investors to understand and analyze. The staff understands that the IASB is by issuing its exposure draft on risk mitigation accounting last December, is exploring a dual model approach under which entities that do not centrally manage entity-wide risk would continue to apply the existing hedge accounting guidance under IFRS 9, while the staff plans to closely monitor and learn from that feedback that the IASB receives on the exposure draft. At this point, the staff does not recommend pursuing a similar dual model approach. With respect to disclosures, under both Path 1 and Path 2, the staff plans to research and recommend revised disclosures about risk management and hedge accounting. The staff believes that this research would include the topics raised in the agenda request from the Council of Institutional Investors on disclosures about risk. And regardless of the path, the staff thinks that to be responsive to feedback received in the 2025 ITC, all hedge accounting disclosures should be reviewed to determine whether they are decision useful. The staff would analyze whether disclosures could be eliminated and what new disclosures could be added to more effectively reflect the economics of using derivatives, including what risks are being managed. And with respect to next steps, based on the board's feedback today, the staff plans to present a more fulsome description of each path and a detailed outreach plan to the board at a future meeting. So thank you for bearing with me for all of that. The questions for the board on this topic are: 1, does the board have any feedback on the staff's project plan? And 2, does the board have any additional topics for outreach and research? And I will send it back to Rich.
Great. Thanks, Erin. Comprehensive tee-up. I'm sure we all have a lot of input to give you, so I'll head around the table. On the short-term project, just as a reminder, that's our next topic. So unless you object to even considering anything in the short term, that might be, you might want to hold your powder, I would say, for the next topic. Did you have a question, Marcia?
Just for the staff, while we think about your overall project plan, which is a parallel path, short, intermediate, and long term, the long term being the one where you talked about potentially a path to changing the pillars, I just want to reiterate, it's my understanding that what you are proposing for the short term as well as for the intermediate term would be unaffected by whether the long term is path 1 or path 2. Is that true?
Yes, that's correct. We think that all of the amendments, when we say directionally consistent, would incrementally allow more transactions to qualify for hedge accounting. So to the extent that a transaction or a type of strategy is now can qualify for hedge accounting under either in the short term or in the medium term, those transactions and strategies would continue to qualify for hedge accounting in the long-term project. So we would not be adding things only to subtract them at a later date.
Great. Thanks, Marcia. Any other questions before I give you an opportunity? Okay. Sue, may I start with you this morning? Good morning.
Sure. And I just want to thank the staff for the memory jogger on the FASB's journey on hedge accounting. I thought it was interesting, and some of the really old stuff from early days, I think, was a good reminder and just interesting to revisit. In terms of the staff's plan on short-term and longer-term projects, I think particularly as it relates to the medium-term, PLM for liabilities, I've always been interested in. So I would continue to be interested in that. Particularly, I think that, certainly there's been a lot of sentiment expressed from our stakeholders with an extreme interest in that. So I was glad to see that was included in your plan. And I think it's contributory, if you will, much like you said, to the longer term efforts. On the longer term efforts, I think as you mentioned, we'd be talking about the approaches maybe more fulsomely at a future meeting. That said, I certainly have an interest in Path 2, just from the perspective of I think it actually is more broad based. And while I do think that there's overlap, at least the way you've described it, between Path 1 and Path 2, I think Path 2 would afford a better solution to the extent we're able to come to it. In other words, the issues that are identified in Path 1 have to be solved in Path 2 as well. So I do have an interest in that. I know you're not asking for our sentiments on that, but I do have a bit of an interest on that. And so I do think that it's time. Certainly we've sort of hit the confines of the hedge accounting model that we have today. And I think if, a lot of the improvements we've made of late have really been to try and strike better alignment between how management considers risk and how they manage their risk. And so I think, if we want to continue down that path, I think, looking at the longer term projects is going to be important.
Okay. Thanks, Sue. Joyce?
Thanks, Rich. Good morning. Thank you, staff, for the board memo and introducing this topic. I support your project plan. I think it's responsive to stakeholder recommendations and requests that we've had over the years. I think the staged approach is one that could alleviate some concerns by stakeholders who had expressed apprehension to making changes to the hedge accounting because they thought that it might be a lengthy process. Here we have potential rulemaking that could be quicker fixes in a time span that I think is appropriate given the issues that you've included in each of these stages. Each stage includes various comment letter feedback, and all of the stages, I think, clearly have the goal to have financial statements better portray the economics of risk management activities and also reduce complexity that preparers have been facing over the years. And both investors and preparers, I think, will benefit from both of those goals. Regarding the long-term project, I think the staff is being considerate by identifying two potential paths. Path 1 certainly more closely resembles the approach that we've taken over the years with amendments and multiple projects while attempting to address the more holistic risk management depiction concerns in the confines of existing pillars. A key shortfall, in my view, with Path 1 is that it would maintain the prohibition of net position hedging, which is a persistent concern, notably expressed by multinational institutions. I am quite interested in Path 2, however, where there's consideration of the potential alignment of the accounting for fair value, cash flow, and net investment hedging models. And I'm also interested in potentially accommodating various types of hedging strategies by different companies, whether it's instrument by instrument or on an entity-wide basis, potentially within a single comprehensive model. As it pertains to disclosures, an overall assessment of the relevance and usefulness of current risk management and hedging disclosures should be well received. I think it should be well received by preparers and by investors. A path that certainly aims to reduce subjective and diverse non-GAAP disclosures should positively impact investors, given their connectivity challenges between aligning GAAP financial statements with the SEC risk disclosures. As part of the disclosure assessment, you did mention potentially addressing liquidity and interest rate risk disclosures, which some stakeholders have requested in the past, notably the investor community. There also has been stakeholder concern about whether the potential interest rate and liquidity disclosure footnote wouldn't capture forward-looking information and forward-looking scenarios, would provide a comprehensive view of the entity's risks. And there's been concerns as to whether or not that would be meaningful in isolation. In fact, whether or not it may potentially be misleading. And so I think that as we think about satisfying those interests by the investor community, which I think are very valid, we want to make sure that we consider, existing disclosures. Banks in particular have the liquidity disclosures that are already mandated by bank regulators, notably the liquidity net stable funding ratio package that banks submit, as well as existing interest rate risk disclosures that the SEC mandates. How can we be incremental and valuable in adding more relevance to that pool of information within the confines of GAAP? So I look forward to the results of your research once you've completed your outreach to both investors and preparers.
Great. Thanks, Joyce. Marcia?
Thank you for bringing us this thoughtful project plan. I am supportive. I like the fact that you're talking about moving on parallel paths, because I think it allows us to make improvements and finalize questions and respond to stakeholder input at a faster rate than if we were to combine everything in one project. As it relates to the intermediate term projects, specifically PLM applied to liabilities, I have always been supportive of this project. And I think what I just said is why it hasn't been addressed to date. I think I'm glad that you are proposing it be its own standalone project, because when we have tried to incorporate it with other items, what's happened is that the PLM on liabilities, it requires different input, different outreach. It tends to slow down some things that could be potentially broader applied across more industries, that we could reach conclusion faster. I'm glad you've pulled that out and you've highlighted it as a path that we can begin now, but is not necessarily going to slow down anything that we could address and respond in a much faster way. And I think that the clarification is important, that by moving potentially on 3 separate projects at the same time, there's not a risk that something's going to be undone in a final deliberation. And I think that that assurance is important for everyone involved. As it relates to the longer term project, again, you didn't ask for views, but I like the conceptual approach of a single model. I feel like we've been on path one through the historical journey, and we're still getting feedback of additional tweaks. I guess I also feel like path one could be a backup if we can't get a path two. So I personally have more energy around and am hopeful that when you have a chance to complete your thought process, that you're able to bring us something that might be a workable alternative around path two. So that's just where my preferences would lie. So I'm glad that we're going to spend some time and energy in that area because I'm guessing you're going to get support.
Great. Thanks, Marcia. Fred, good morning.
Thanks, Rich. Yeah, I'd also like to thank the staff for a very thoughtful approach to hedge accounting, and I do support the approach being taken in terms of the 3 steps. We'll talk about step 1, the short term, later. We'll talk about PLM probably upcoming. And I think it's interesting because unlike others, I wasn't always supportive of PLM for liabilities. And I think part of it was a time issue. Was in other words, when we voted on that, it was about really understanding PLM for assets. I certainly think I understand it better now, and I think it would be a good time to readdress that because I do think there's some opportunities there. In terms of the longer term approach, I'm a strong supporter of path 2. A few things. I mean, today we have hedge accounting as was laid out. It's both significantly limited and it's also very difficult to apply. It's also, from an investor standpoint, difficult, if not impossible, to understand the positions of institutions relative to hedges. So I do think a step back is very important. I think a goal for, at least from my standpoint of the project, really is to simplify, reflect the economics of hedging that should expand significantly the use of hedge accounting by many entities. Thus, I really like the single model approach that you discussed. And it would also expand hedging itself and risk management, because I think what the academic study has showed is that when we rethought some of the issues and relaxed some of the rules, that not only hedge accounting expanded, but actual hedging and risk management expanded. So I think that's an important goal. I would say I was reflecting as thinking about this on the 2003 bank failures. And while it was clear in all the studies that accounting wasn't an issue or a cause of those bank failures, I think poor risk management was a cause of those bank failures. And I think it's important to think about, the folks who wrote FAS 133, in my view, were probably thinking what's going to blow up an institution is going to be the use of derivatives. But actually what happened with these institutions was they didn't have sophisticated interest rate risk management, in my mind, and it was the lack of use of, rather than the use of, it was the lack of use of perhaps derivatives and more sophisticated approaches that was a contributing factor to those. And just as an aside, I think it's important to think, because we're going to address one of those issues in a bit about held to maturity securities, but it's important when you look at those bank failures too, that some of them was related to HTM portfolios, but some of those failures were related to loan portfolios too. So again, this makes me think we need to step back and take a broader view of it with a different mindset than the folks who wrote 123. So I do support a relook at the model and believe it would be very difficult to achieve some of the goals that we want to achieve with a path 1 that built on to say the base we currently have. And it's time, I think, for the board to step back and take a broad look. Thanks.
Thanks, Fred. Christine?
Good morning, staff. Well, you've heard a lot of gratitude from the board, so I'll just add mine to that as well. Really appreciate the work that you've been doing on this and the very thoughtful project plan that you've brought forward, which I do support for many of the reasons that prior board members have already voiced. Just a couple thoughts on path 1 versus path 2. I think that when we have financial reporting that reflects the economics of transactions, that actually reduces complexity for both preparers and for investors because the financial reporting is actually communicating what's going on. That makes it easier for accounts to account for. It makes it easier to explain. It makes it easier for investors to understand. And I think the problem that we've had in hedge accounting, as you described in your tee-up, Aaron, is that for years we've been trying to force square economics into a round accounting hole, and it doesn't work. And it creates a lot of complexity. It makes it, as Fred said, impossible for investors to understand what's going on based on the information that's presented in the financial reports. And that would be both in terms of how things are recognized, how they're measured, and how they're disclosed. It's not just the disclosure that's a problem. So between the two paths, I would be very reticent to go down a path one. I think that's what we've been trying to do for a really long time. I think we've made some improvements on the margin following that type of path, but I think we've kind of gotten to the end of the line. And over and over again, as we've tried to make some fixes on the margin, there's been concern about really starting to have to impact those core pillars. And that's just a very uncomfortable place for certainly I'll just speak for myself, for me to be, which is why I've been uncomfortable with some of the proposals that have come up from the staff where we've tried to make improvements. It's not that I don't want to make improvements. It's just that trying to do it within the existing model, I think we've done as much as we can do. So I would not spend a lot of time on path one. I think that it would be better if the board decided that a path two just wasn't feasible to really just do a disclosure only project and not go down path one, because I just don't think it's going to be successful. It reminds me a lot of what we've been doing for years in liabilities and equity. And while we might end up reducing complexity in one tiny part of the model, we end up creating complexity somewhere else because there's threads throughout. So in terms of, the longer term project, I would be very encouraged if the board were to undertake a path two. I think that in the long run, having an objective that reflects or having accounting that reflects the economics of risk management activities is going to be less complex, easier for people to explain, easier for investors to understand. But I would also like to stress that this is a very complex area of financial reporting. And if we're going to make meaningful change, all the way back to what is the objective of financial reporting in this area, it is going to be critically important to bring the board along on the journey throughout the project. So lots of education, not just, once in a while, but consistent education and consistent involvement of the board throughout the project so that they have the opportunity to provide feedback as the staff is hitting junctures in the road and having to make some decisions about directions so that they fully understand what the alternatives were. Because in my experience, in my 10 years as a board member, what I've observed is that projects fail for two reasons. One is that the board members really don't think that the accounting is going to provide decision useful information. The other reason is they don't feel comfortable. They don't feel like they really have their arms around all of the potential unintended consequences of a decision that they're making. And so they'd rather stick with what we got than make a decision to go forward with something that they feel really uncomfortable about because they don't fully feel prepared to make the decision. And with a project of this magnitude, keeping the board involved and bringing them along on the journey, I think is really going to be important for this to be successful. And I think it's an area that really needs to have a successful outcome. So I wish I'd be around for the journey, but I wish you all the best.
Thanks, Christine. Hillary.
Again, really appreciate all of the hard work from the staff and stakeholders who provided feedback and continue to provide feedback on hedge accounting. I'm very supportive of the staff recommendations with regards to the project plans for the short-term, medium-term, and long-term projects. On the medium-term projects, I have generally been a fan of expanding portfolio layer method to liability. So I look forward to that coming back to the board in the not so distant future. And with regards to the long-term project, a lot of great points have been brought up by other board members with regards to this. Certainly, I think you have path 1 and path 2, both could be viable paths. I probably support more exploration of path 2. One, because I think our existing model needs significant change, and I think it's going to be really hard to make those significant changes in the context of the existing model. We all know that when we change any word, we get pushback with regards, well, what does this mean and what impact does this have in another area of the guidance? I think much to Christine's point, right? Pulling threads in one part of the guidance here makes it where I'm concerned that path 1, while it will come from the best of intentions, may not get to the end result that we're looking for based on a lot of the challenges that we've already had with regards to the activities on hedging activities over the last few years. So I do think that being tied to the origins of hedge accounting as they exist today is going to continue to be challenging for us, right? It was written as a privilege, not a right. And I think we really want to flip that on its head, right? Of it should be reflecting the economics, right? And that should be something that's providing decision useful information to investors. So we should be trying to make it as available as possible, right? For entities to be able to apply that. I also do agree with the staff recommendation not to go down kind of a dual model approach. So appreciate that unlike the ISB, right, where they're kind of adding on a model on top of their existing model, appreciate that the path 2, would be a wholesome relook at it, right? We wouldn't have kind of here's the existing model and now we're adding on top for entities that are hedging on a net position basis. So I certainly appreciate that. I do think that, though, when I think of path 1 and path 2, I think that everything you've identified as being addressed in path 1, potentially addressed in path 1, would be things that need to be addressed in path 2. So I kind of think it's the best of both worlds, right? Trying to be able to address those issues through a more holistic approach. And I know that you've talked about the model as being scalable. I think that's really important, right? We have entities that hedge for very different reasons. Some have very simple, your point on hedging, variable rate debt and trying to, swap it to fixed versus banks and other financial institutions that might be hedging much more complex strategies. And I think we need to make sure no matter what under path 2, that it will not be harder for anyone to apply hedge accounting than it is today. That needs to be a baseline. It can only get easier from here is the way that I would think about path 2, but then expanding it so that more entities could apply hedge accounting or those that are hedging on a net basis are better able to reflect that through hedge accounting. So I think that that's a really important part of thinking about path 2. And that's something that I'll come back to over and over again as we kind of as you bring the board along in this process, is making sure that we understand that if someone's doing X today, what impact would that have on them under the new model? I think that's going to be an important part of the process for purposes of bringing our stakeholders along as well. And so I think that you guys have really a great plan in place. I think we've got the right team to do it. I think it's the right time to do it. So I have a lot of confidence in it, but I think it's a tough ask, right? We're looking for a model that's simple enough for small entities and non-banks to understand and apply. It's flexible if you're trying to apply it on an individual basis or on an overall, net position basis, and that it's going to be sufficiently robust to address practitioner concerns, around or abuse or auditability. So I think it's a big ask, but I think we should be able to do that. So.
Great. So hearing general support for the direction that the team's laid out, just a couple incremental comments. Short term, we'll get into the details a little later, but I think the key there is making sure that we're focused on more permissive as opposed to restrictive, and I think you're doing that. On the medium term, so let's go PLM for liabilities. I might suggest we change the name to PLM for certain liabilities, because my guess is that's what you mean. Don't know. And in fact, I think that's going to be a key first step in this, is identifying which ones we're talking about. Are we talking about closed pools, open pools, existing transactions, other transactions, renewal of transactions? Do we want to permit hedging for OPEB liabilities and the related discount rate? for pension liabilities? Do we want to permit someone to hedge their effective tax rate? There's an awful lot of things on that right side of the balance sheet that I think when we say PLM for liabilities, we may not mean. And I think making sure that we have the definition of the attributes of liabilities as succinctly as possible is going to be a key first step in that. But I am supportive in taking a look at that. I think it makes sense. On the long-term basis, it's kind of interesting. Path 1, Path 2, I think it's fair to say, I don't know that any of us would in good faith say we would create the standard we have right now if we had a clean sheet of paper. So that kind of drives you to Path 2. That being said, I do think, Christine talked about bringing the board members along. I do think bringing our stakeholders along is key. I think it's essential that we're working on all three of these paths at the same time, to echo Marcia's comments, because sequencing them means we're going to be here forever. And I don't think anyone has that intention. On the long term, though, and when it comes to bringing our stakeholders along, I do think the board's going to have to make a decision on. I'm not a big fan of multiple documents. I'd rather we did all the work, got all the input, and could issue one. But do we need a higher level of preliminary views to get buy-in from our stakeholders as to a path we're headed down? Because we will get questioned to death on the details of any new model. And we don't want another DIG, right? I don't need another green book. So how do we avoid that? And can we get a general acknowledgement of the model? And I think part of the determinant there is going to be how aligned is the board at the time on that model, and whether you go exposure draft or preliminary views. I think I talked about a preliminary views document at the start, but I think that's something that'll be important for the board to decide. And then moving on to disclosures, whether it's fair value, whether it's hedging, whether it's derivatives, we tend to write disclosure requirements that make sense for one transaction. And when we have a large volume of transactions, our disclosures are restrictive in the way that they're drawn up, but I don't know what someone does with them when it's a huge volume of transactions. And I think this will be a perfect example of that. And maybe we need to really step back and say, do we need to take a different way of looking at disclosures? If we create a requirement, someone has to do it. So if we require notional amounts, somebody's going to disclose a huge volume of notional amounts. I don't know what they do with that when it gets to a certain point. So maybe we really need to take, and this might be a great opportunity to take a fresh look at that and what you do when you have more than a few transactions. How do you effectively convey magnitude that's very hard to understand and sensitivity that's very hard to understand? So with that, I'll add my support with my prior 6 board members. I would love to finish the long-term project before I and Marcia. I'm sure Marcia would too. I'm not sure we can do that, but looking forward to at least that part of the journey. So with that, Erin, do you have everything you need on the first issue?
Yeah, we do.
Okay, so we're going to turn it over to Michael for the second topic.
Thank you, Rich. I will tee up questions 1 through 4 together, given their interrelatedness. As part of the analysis of the feedback received on the 2025 ITC, the staff has identified 3 discrete issues that can be addressed in the short term. These issues relate to exceptions or limitations to the general hedge accounting model. The objective of the project would be to remove these exceptions and limitations to better align risk management activities with financial reporting. While the issues would require minimal targeted amendments to the codification, stakeholders indicated that they would result in meaningful benefits for preparers and investors. The 3 issues identified as part of the potential short-term project are the following: hedging of interest rate risk for held-to-maturity debt securities, amending the SOFR benchmark rate, and using float-to-float cross-currency swaps with different reset dates as hedging instruments and net investment hedges. In evaluating the agenda decision criteria, based on the feedback received from a diverse set of stakeholders, the staff believes that each of the 3 discrete issues meet the agenda decision criteria. As such, for question 1, the staff recommends adding the project to the board's technical agenda that would include each of the 3 discrete issues as one project. Next, I will discuss the solutions and alternatives for each of the 3 discrete issues for the board to consider if they decide to add a project to the agenda. For question 2, related to permitting hedging of interest rate risk for HCM debt securities, As the current guidance has explicit prohibitions related to hedging interest rate risk for HTM debt securities, the staff recommends adding interest rate risk as a permitted hedge risk and removing the related prohibitions. This change would provide better financial reporting information because it would more closely align hedge accounting with the economics of an entity's risk management activities, particularly for financial institutions that aim to manage interest rate exposure, more accurately reflect net interest margin for financial institutions, and provide more transparent information based on the required GAAP disclosures for derivatives that qualify for hedge accounting compared with derivatives that do not qualify for hedge accounting. For question 3, related to removing the OIS parameter from the SOFR benchmark rate, the current guidance has the specific OIS parameter in the existing term. As such, the staff recommends removing the OIS parameter to better align SOFR with other rates in the benchmark interest rate listing, which do not typically restrict rates to a particular tenor. The various SOFR-based rates are widely quoted, widely used, and commonly referenced in interest rate-related transactions. This solution would benefit entities that apply fair value or cash flow hedging. Furthermore, this change would better align fair value and cash flow hedging, as all SOFR-based rates contractually specified in variable rate instruments are already permitted to be hedged in most cash flow hedges, thereby resolving a conflict that exists in the current hedge accounting guidance. For question 4, permitting float-to-float cross-currency swaps with different reset dates to be hedging instruments in net investment hedges, market conventions have been established since reference rate reform, with no standard repricing intervals and dates across all jurisdictions. The requirements in current GAAP present challenges in achieving hedge accounting even when the hedge is effective. As such, the staff has identified 2 alternatives for the board's consideration. Alternative A would provide a clear and operable path for these instruments to qualify for hedge accounting by modernizing existing guidance to reflect current market conventions while limiting interest rate exposure. It leverages a concept in current hedging guidance, which has been applied in practice without significant issues. It also limits exposure to a short period already considered insignificant under the shortcut method, accommodates commonly used rates such as SOFR OIS and Euribor, and would not require quantitative calculations to demonstrate that fair value changes are driven by foreign exchange rates. Alternative B would achieve a similar objective, but would require additional quantitative assessment to demonstrate that fair value changes are predominantly driven by foreign exchange rates. There have been historical challenges with applying such thresholds in GAAP, and this incremental analysis to the effectiveness testing would increase costs, judgment, and complexity relative to alternative A. As such, the staff recommends alternative A because it is clear and operable and leverages a concept already used in existing hedging guidance. It would also be less costly and less complex to apply than alternative B. I'll turn it back to the board to discuss question 1, which relates to adding a project to the board's agenda, and if any of the discrete issues are added as a project to the agenda, questions 2 through 4, which relate to specific solutions to the issues the project would address.
All right. Thanks, Michael. So just to be clear, you're going to answer questions 1 through 4. Okay. That way, and if we don't add it, you've simply provided your views on those other issues. All right. So.
Sure, thanks. So I agree with adding a project to the agenda on all 3 of these issues. I think specifically as it relates to hedging HTM debt securities, I think that, the staff has sufficiently demonstrated the mismatch. I think that, we've consistently gotten feedback from our stakeholders about the importance of this issue. And I think, the solution would align better the way management considers entity-wide risk. And I can't take credit for this, but I just love the sentence that you put in the memo about an accounting construct should not impede an entities from better reflecting their risk management activities in their financial statements. And I just think that that perfectly crystallizes this issue. And, and I also think that as we're talking about in the previous part of the meeting today, I think this is one step towards what we're trying to accomplish, perhaps with the broader project. So I think it's a step in the right direction. On the second issue, amending the SOFR benchmark rate, I think we have to acknowledge that there's no longer a transition. And I think that some of the concerns that we had back in 2022 when we were making the improvements have kind of fixed themselves, if you will, in terms of the underlying market and is it widely used? Is it widely quoted? Some of the concerns that we had back then about the ARC and their perspectives. So I would be supportive of the staff recommendation on that one as well. And then on the third issue, the float to float cross currency swaps and net investment hedges. To me, this is another one that came out of the LIBOR secession. And so while we had some temporary relief, I think that has gone away, but we're seeing that the issues still persist. So it seems to me that this is something that we should address. And I do agree with the staff's recommendation on alternative A. I do think we had some good discussions in our small group meetings on whether we should, I'll call it, modernize the language or not. I know that the staff proposal had some alignment with the language in the shortcut method, but I was wondering if, perhaps eliminating the term generally and maybe having a benchmark of less than 6 months would strike some consistency in terms of clarity and operability. So I don't know if that's a drafting issue or, something that we should think about as we go forward, but I thought I'd pose that here.
I think you'll have some company in those
Okay.
thoughts. So,
And I think we don't think there, if it was limiting to 6 months or less, we would be scoping the same population. So I think making clear would be
That's what I
helpful.
was thinking. It sort of would encompass it rather than
Yes.
exclude anybody.
it'll reduce off, let's call it off our authoritative guidance interpretations of what that means. Okay. Joyce?
Okay, so I support adding a project to the technical agenda for all three of these issues. As it pertains to the held to maturity debt securities, I think that the staff has outlined the rationale quite clearly, and I agree that the agenda decision criteria are met. This potential change, I think, is quite meaningful. When you think about net interest margin, which is clearly one of the most important metrics in bank analysis, it's currently economically incomplete and sometimes misleading depending upon whether accounting hedging requirements are met. And it can be even more notable during volatile interest rate environments. Banks frequently present a core NIM or an adjusted NIM in order to compensate for that and reflect the outcomes from a more economic perspective. So I think permitting the hedging of the interest rate risk by making a targeted change to 815 is an opportunity. It's an opportunity for NIM to be more reflective of asset liability management activities and therefore economic spreads. It's an opportunity to reduce non-GAAP measures and reduce subjectivity and incomparability and bolster peer-to-peer analysis that investors struggle with. And it's also an opportunity to mitigate artificial earnings volatility, which is caused by the accounting mismatches and the prohibitions in achieving hedge accounting. As it relates to issue 2, I support staff recommendation. I agree that these issues have met the agenda criteria. Certainly maintaining these restrictions would just continue to artificially narrow the eligible risk components, and that will certainly increase basis risk between the hedging instrument and the hedged item. It's my understanding, as you've pointed out, Mike, that derivatives are being structured using, for example, term SOFR and many commercial loans and debt instruments reference term SOFR. So this is clearly an opportunity for us to make targeted, narrow improvements to remove the OIS qualifier and provide stakeholders with the flexibility need to reduce complexity and certainly have better financial depictions in the financial reporting. Regarding issue 3, I support alternative A quite favorably. As you've mentioned, Mike, it is conceptually aligned with existing guidance, which is understood. Unlike alternative B, it does not have the subjective thresholds that are already known to be challenging for preparers to apply. Again, there's an opportunity here to reduce unnecessary complexity and to be more in line with the current interest rate conventions. Furthermore, the hedge relationship would be subject to the hedge effectiveness tests to ensure that the hedging instrument appropriately offsets any of the foreign currency related risks.
Thanks, Joyce. Marcia?
So with regards to question 1, yes, I support a project. I believe that the staff has presented workable alternatives in all cases. I think all 3 of these issues have been brought to us by stakeholders and that your approaches are responsive to that and that this meets our criteria and the direction that we want to go conceptually with hedging. With regards to issues 1, 2, and 3, I would just point out on issue 2, to me, that feels like a housekeeping change. It feels very appropriate to do this at this time. Markets have established behaviors, and I don't think we intended to be as restrictive as it's being applied right now. So I'm very supportive of that. I'm supportive of all of them, actually, all of your, it's just a matter of, that one in particular to me feels like housekeeping, feels like we need to do this. And this is an opportunity to address that. And then with regards to question 4, which is the 3rd issue, I am supportive of your recommendation. Alternative A is workable. I like the fact that it leverages, currently understood practices.
Okay. Thanks, Marcia. Fred?
Thanks. I also will support adding the project. And on the 3 issues, I would say on held to maturity, I think that is helpful and do support allowing hedging. It's interesting in my mind that, banks make a decision on securities, whether to hold in portfolio or to sell, different criteria, but much the way they think about loans, whether to hold the loan or to put it in available for sale. And in addition, what's underlying those securities is loans. And so I think the idea that one category, I understand the concerns, can't be hedged and the other is a significant hindrance to overall application of hedge accounting. So I do support the expansion. I do recognize, I think there are some concerns by stakeholders about expanding to HTM. I mean, HTM is quite restrictive. And also I think there is some concerns that what we heard from investors is while they supported hedging HTM, they didn't necessarily want to see an expansion of HTM portfolios. And by allowing hedging, it could expand the portfolios. That said, I don't think the economics of determining whether something's HTM or not is primarily driven by the ability to hedge it. I think it's primarily driven by that decision that banks make. Do I want to hold these in portfolio or do I want to sell that? So as a result, I think I can get myself over that issue in terms of that. In terms of disclosures, I think the bank, the staff did a very good job, at least demonstrating to me, that under current guidance, investors will get meaningful disclosure about the hedge portfolio of HTM. Clearly today, investors significantly use that fair value of HTM, knowing it's not hedged. So I think that those requirements, understanding the hedge on those HTM is going to be important. But I think the staff demonstrated to me that requirements today would allow investors to understand that impact. So I'm supportive of that. On issue 2, the SOFR benchmark, I mean, I think it's important. We have been a little bit slow to expand it to term SOFR. I think that was in part due to the view that term is derived rather than a trade-based mark. However, I think as has been demonstrated, the expansive use of term SOFR in so many instruments today means there is significant transparency there that essentially, in my mind, equates to having a market for that. And so I think that has developed, and I'm supportive of the decision to expand to term SOFR. And And on the third issue, cross-currency swaps, I certainly support the staff and do support option A. I think when we're talking about short-term projects, operability is really important. And that's clearly what I think option A accomplishes. Thanks.
Thanks, Fred. Christine?
I agree with the staff recommendations on all questions, question 1 through question 4. Just a few comments. On the HTM, I found the discussion in our memo on price risk and hedging combinations of risk and the language that was just proposed. I know that we're going to be going through drafting, so I just wanted to put that out there that I needed some clarification around that. And I know the staff is aware of that. On SOFR OIS, I agree with Marcia. I kind of view this one as a housekeeping issue. When we added SOFR OIS to the benchmark rate list, it was the only tenor that existed at the time. I think we even stated that we would stand ready to add or adjust as necessary once the markets were sufficiently developed. It's taken some time, but I think that we're in that position now. So I do think that it's appropriate for us to go ahead and make that change at this time. And on the alternative A, I support the staff recommendation there because I do think it's the most expedient and consistent with what we've done in the past.
Thanks, Christine. Hillary?
I agree with the staff recommendation to add a technical project with all 3 of these items to them. With regards to hedging HTM, I certainly think that this will be a significant improvement for interest rate risk management toolkits for financial institutions. So I'm very supportive of that. Likewise, though, to Christine's comments with regards to, we would obviously be expanding it to interest rate risk, but would we also allow the combination of foreign currency, credit, or interest rate to be hedged? I think that's something important to clarify if that's even a hedging strategy that folks would be looking to enter into. On OIS or removing OIS from the existing SOFR benchmark rate, I mean, I would love to not have benchmark interest rate lists that we have to maintain. We'll just start there. So I am supportive of generalizing SOFR, right? So that more items are going to be allowed to be included. Certainly, I know that's part of a longer term project, but just put out there very supportive with regards to the deletion of OIS today from the benchmark interest rate list. And then with regards to question 4, on the float-to-float cross-currency swaps, certainly agree with the staff recommendation of alternative A. Similar to Sue, I had concerns with the use of the term generally and then 3 to 6 months. Certainly, I think tying it to shortcut, understand why we would do that. But I do want to make sure that we are allowing for implementation for this to be applied in a clear and consistent manner. And so if we can remove judgment that we're not expecting there to be significant judgment, if we can do that in drafting, that'd be much appreciated.
Great. Thanks, Hillary. So I support adding all 3 projects to our agenda as well. On HTM, hedging interest rate on HTM debt securities, I agree with the staff recommendation. It's never really resonated with me to blame bad business decisions on accounting, but I think it is fair to say that accounting should reflect the economics, and we have a mixed measurement model that somehow we have to put together. And I think this at least goes partway to addressing that. So I'm definitely supportive of that. I would have probably added in a requirement for private companies to disclose the fair value of their HTM debt securities on the face of their balance sheet, but that's not part of this project. So far, agree with the amended definition or the amended description of SOFR as a benchmark interest rate. And on question 4, I also agree with the staff recommendation, alternative A. And I'm going to just echo, I know the phrase generally 3 to 6 months or less is used elsewhere. If I had written that in my 8th grade English class, I probably wouldn't have gotten a very good grade. I don't know how. I recognize practice can interpret that, but if we really mean cap of 6 months, we should just say that. There's too many modifiers in there, and I think it just subjects entities to second guessing and interpretations that have been historically made in other areas. If we just mean 6 months or less, 6 months, we should say a cap of 6 months. So I would certainly encourage that. With that, let me turn it over to Zach, who's going to take us through our next couple of questions.
Thank you, Rich. I'll now tee up questions 5 through 8 on entity applicability and transition. After considering whether the amendments being proposed would have any unique implications for public business entities, private companies, or not-for-profit organizations, the staff has found no basis for special consideration to be made for any certain class of entity. Due to this, and the fact that these changes are meant to simplify the application of hedge accounting based on consistently received feedback in a way that all entities could benefit, the staff recommends that the proposed amendments apply to all entities. With respect to transition, the staff recommends that the board require prospective transition as the most appropriate method for entities adopting the proposed amendments for all 3 issues. Given that the solutions in issues 1 and 3 effectively allow for the establishment of hedge accounting relationships that are not allowed under current GAAP, the staff believes that there is no alternative viable transition method, as there would be no previous hedge accounting relationships that would be affected. While issue 2 could affect entities that have existing fair value hedges which designate SOFR OIS as the benchmark interest rate in lieu of SOFR term, which may benefit from simplifying effectiveness testing, the staff believes that in practice, application of modified or regular retrospective transition would be outweighed by the costs. This is also true for hedges of forecasted debt issuances, as the cost of applying those alternative transition methods would outweigh the benefit given the short duration of hedging forecasted debt issuances. This recommendation would also be consistent with past changes to reference rates that can be designated in a hedge of interest rate risk, as well as stakeholder feedback received on the 2022 proposed update. If the board does decide to require prospective transition for all 3 issues being presented, the staff also recommends that the board require transition disclosures as laid out in question 7 on the handout, consistent with Topic 250. Lastly, the staff recommends that early adoption be permitted for all entities on any date after issuance of the final update. While the staff does understand the view that allowing early adoption may affect comparability among companies, application of hedge accounting guidance is already optional, meaning that there's already some degree of variation in reporting conclusions today. In addition, these issues are narrow in nature, and the staff anticipates significant stakeholder support related to them. As such, the staff believes that any potential non-comparability stemming from permitted early adoption is justified for these reasons. With that said, I'll pass it back to the board to discuss questions 5 through 8 on the handout.
Great. Any questions on 5 through 8? Sue?
So I'll make it easy. I agree with the staff recommendations on questions 5 through 8.
Thanks, Sue. Joyce?
I also agree with the staff recommendations for all 3 questions.
Marcia?
I vote yes on each question.
Brad?
So vote yes on all the 4 questions.
Christine?
I also agree with the staff.
Hillary?
Agree with the staff recommendation on questions 5 through 8.
And I agree with the staff recommendations on 5 through 8. So with that, to you, Jack, to wrap us up.
Thank you, Rich. I will now be teeing up the remaining questions. Based on ITC feedback, stakeholder outreach, and staff research, the staff believes that the recommended changes to the current hedge accounting model would A, better reflect the economics of entities' current risk management activities, and B, expand the population of valid economic strategies that are able to achieve hedge accounting. These changes would provide financial statement users with better and more decision-useful financial information. The staff does not anticipate entities will incur significant costs, as entities will be applying the existing hedge accounting models, with some incremental process and internal control updates, particularly for entities reintroducing instruments after the sunset of Topic 848. Additionally, hedge accounting is elective, so entities can make their own benefit cost analysis to determine whether they will utilize the guidance. Therefore, the staff thinks that the expected benefits of the recommended changes would justify the expected costs. Considering the number and nature of the distinct targeted improvements on the application of hedge accounting, the staff recommends that the board provide a 60-day comment period. I will now pass it back to the board to discuss questions 9 through 12.
Any questions for the staff? Not seeing any. Sue?
So on question 9, I have received sufficient information. On question 10, I do think the expected benefits justify the expected costs. And I agree to proceed to a draft of the proposed standard by written ballot. And then in terms of the comment letter, I'm happy with 60 days. I think that's sufficient.
Okay. Joyce?
Question 9, I've received sufficient information. Question 10, I believe the expected benefits would justify the expected costs. 11, I give the staff permission to draft a proposed update. Question 12, I support a 60-day comment letter period for the reasons that the staff has expressed.
Thanks, Joyce. Marcia?
Yes, 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 and I'm comfortable with 60 days.
Fred?
Yes, sufficient information. I do want to say I think this is kind of an exception to the rule in terms of moving straight to a exposure draft rather than stepwise. I do think in this case this kind of one and done approach is appropriate because I think we've debated these issues in the past. I think they've been fully vetted. I think that we've heard from stakeholders, and so I do have sufficient information. I do think the benefits exceed the costs, and I authorize the staff to proceed to a draft, and I also support the 60 days. Thanks.
Okay. Christine?
So yes, I agree that I've received sufficient information. I also am not normally a fan of one and done approaches. I did appreciate the staff coming around, giving us a heads up and talking to us about why they felt that it would be appropriate in this case. And I agree with the analysis and for the reasons that Fred just voiced. On cost benefit, I think that it does meet the hurdle there. I give permission to draft an exposure draft, and 60-day comment period is fine.
Okay. Hillary?
I've received sufficient information. I do believe that the expected benefits justify the expected costs. Certainly authorize the staff to move forward with a draft proposed update, and I think 60 days is appropriate for a comment period.
Okay. And yes to questions 9 through 11, and 60 days is appropriate. So with that, I want to thank our team. I want to thank all the stakeholders who provided input to our team as they work through these issues. And I look forward to our exposure draft being issued and getting some input from broader stakeholder groups. So thank you. With that, that concludes today's meeting. Thanks, everyone.